Hi, I'm Andrew Baskin, the Managing Director at Harbour Asset Management. And today I'm going to talk about why markets have been so volatile and where we're focusing on investing now. So around about a year ago to this month, inflation really started to flare. And that's because there was just excess demand across the world. And that excess demand was suddenly made worse by the invasion of Ukraine, which created a whole lot of supply chain issues that were already stretched. So central banks went from mildly putting their foot on the brake to really slamming the brakes hard to target inflation. So interest rates jumped. In fact, they jumped by more in the last year than they have for more than 3 decades. And really, this is the factor that sparked market volatility. But here's it. Whilst much higher interest rates might paint a more difficult picture for households and businesses in the time frame ahead, markets can be very forward-looking. So we experienced a lot of market volatility last year. In fact, equity markets generally bottomed or troughed out in October last year and have mildly recovered since then. So just about now we're contemplating, have we got the right investment strategy for the balance of this year? What's going to happen to inflation, and will central banks pause in their tightening of monetary policy? And these are all the right things to think about. But in addition, there's a couple of other factors that might come into play. In the last month or two, we've witnessed China reopen their economy more rapidly than many had anticipated. This is the world's second largest economy that's largely been closed for more than 2 years. What we're witnessing right now in China is a significant remobilization of the population. They're getting out and about, and they're spending some of their savings that they haven't been able to for the last 2 years. I would expect this year the reopening of China will continue to be a very important theme and may prevent the world economy falling into a recession. Having said that, I still think there are risks for household spending, particularly in countries like New Zealand, where we've lifted interest rates a long way and we're beginning to experience the impact of higher mortgage interest rates on the ability of households to spend. And it could be that matters get a bit more grim before they stabilise and improve. But again, I'll say this, I think markets can be forward-looking and may well look through that period of depressed spending. We could well see some sectors like the healthcare sector and the technology sector continue to edge out important gains as specific companies are successful in implementing their strategies. I also think that the bond market today offers a reasonable real yield, and we've seen interest rates stabilise at much higher levels, and I think this provides a good platform for investors as well. Where I'm a little bit more cautious is where companies are exposed to combinations of discretionary spending or the housing sector. And I think there's a degree of uncertainty for the near term in that regard. So I'll pause there and say one more thing, that today I'd much rather be building strong portfolios for my clients for the next 3 to 5 years than a year ago. And the key pillar that provides that confidence is the controlling of inflation.